Welcome to the Opportunity series brought to you by OptionsLake, creating opportunities through the power of options. This series of videos will cover a high-level view of how options can be leveraged by a typical individual investor. In this video, we're going to talk about options creating a favorable risk-reward profile for you. This is an extremely important topic, especially the kind of advantages one can get from options trading. So breaking the risk reward linearity with options. So, most of us are very familiar with stocks trading, and typically stock is all about one-to-one risk reward, a very linear equation. If you're trading a stock, if stock makes $1, you make $1. If stock loses $1, you lose $1, right? It's as simple as that. But in options, it actually breaks the risk reward linearity. Options provide the flexibility to calibrate the risk reward and the probability of a trade by using different strategies. And we are going to elaborate on this point in the next few slides with several examples. So this is the first example of a call option, how a call option breaks the risk reward linearity. A call option buying is a bullish trade. So let's look at this example. Apple currently is trading at 164.45, let's say, right, denoted by 0.1. Point 2, right? A call option contract that expiring on 18th March 22 with a 165 strike is currently priced at $4.30, $4.30 per share, equating to $430 for an option contract, which amounts to 100 shares. A 5% increase in Apple stock, actually based on this call option risk reward profile, will result in $510 in gain, equating to 118%. So, think about it for a moment and pay attention, right? Just a 5% increase in stock would result in 118% in gain. And that's what really we mean by breaking the risk reward linearity. Had any one of you been trading Apple stock, a 5% increase would actually lead to only 5% in gains, right? So that's the big difference. Let's look at one other scenario, a 10% increase in Apple. Now, what would it yield to? It will actually result in 280% in gains, as you can see from this risk reward profile. And similarly, on the other side, if we get into a bullish trade and the Apple actually comes down, so a 5% decrease in Apple will also result in pretty heavy losses, which will amount to minus 69% in this scenario, right? So but again, no matter how low Apple moves, your loss will always be capped at the price of the premium that you have paid buying the option, which in this case is $430. So hopefully, you at least getting a sense of how the risk reward linearity is broken, and at the same time, how it's even more important in options trading to get your direction right? And that all leads to technical analysis, which tackle in another video. Here's another example, right? Of the risk reward linearity breaking with options, but here with a bearish trade on buying a put, right? So Square currently is trading at, let's say, $119.80. A put options contract that expiring on 14th April 22 with 115 strike is priced currently at $935. Now, a 5% decrease in Square, considering this being a bearish trade, will result in $252 in gain, which again equates to 27%. A 10% decrease results in 59.5%, of profit. And a 5% increase will result in $211 in loss, which again equates to about minus 22.5%. So you see, there is this whole pattern that you can recognize in terms of how the risk reward linearity is broken with options trading. Let's look at an example of a high reward, low risk trade. This is a butterfly that has been constructed. This is Tesla. And if you look at the butterfly here, it's with strike of 845, 850, 855. Okay. So Tesla currently is trading at $810.75. And the butterfly that has been constructed has a $10 wide wings, right? Which is the difference from 845 to 855. So, if Tesla stays anywhere between that range, it would be profitable, as is indicated on on point 3. Now, maximum profit of this trade is $490 if Tesla closed up at 850 on 4th of March. So if you look at the maximum reward to risk ratio in this case, it's going to be 490 to 10, 490 being the maximum profit, 10 being the investment. So which translates to 49:1. However, the probability of this trade being successful is very low and is at 4.56%. It's low because we've only given a $10 wide chance for us to be successful, right? Now let's look at this trade, the same strategy, but a different way of constructing it. So this is a Tesla butterfly, but the way it's constructed is with 835, 850, and 865 strike, which means that this trade is going to be profitable as long as Tesla stays between 835 and 865, right? But on the other hand, if you look at the maximum profit, it's 1400 at 850. So the maximum reward to risk ratio in this case is 14:1, right? But at the same time, the probability of this trade being successful is 13.65%. So if you really compare and contrast the prior example to this, it's the same option strategy. It's just the way it's constructed is different. And because of that, you see that there is a big variance in terms of maximum risk to reward vis-a-vis the probability of success. More the reward to risk is, lesser is the probability. You have the advantage of calibrating your risk reward vis-a-vis your probability of success of your trade, by strike prices and expiry series, right? This topic, options, always remember, can give you the flexibility to create numerous risk reward profiles, not only with different strategies, but numerous risk reward profiles within the same strategy, as we just elaborated with the two butterfly examples. The risk reward needs to be weighed along with the probability of success, right? Because higher reward risk may look attractive, but could become very speculative. You can create risk reward profile that's right for you through a combination of the right option strategy. We just talked about few examples here, in combination with strike price, expiry, etc., right? And your strategy should be backed by sound technical analysis. Options is one of the most creative financial instruments available to all of us. And despite many misconceptions that exist around how options are really only for the big guys, there are ways for an average retail investor to leverage options. All it takes is a little bit of foundational education and potentially some hand-holding. That's what we at OptionsLake do. If you'd like helpful tips on options on a regular basis, make sure to hit the subscribe button. For other resources like blogs, articles, please visit our website at www.optionslake.com.